Hey guys, and welcome back to the Young Investors Podcast. We're up to episode 18. Joining me here is Brandon. How's it going, Brandon?
Yay! Yeah, I'm going pretty well. How you going, mate?
Yeah, I'm good. So we're on my channel for the first time. So if you haven't heard, and you've just sort of stumbled upon this, we're going to be alternating between the Aussie Wealth Creation YouTube channel and my channel, the Hamishwhodder channel, going forward. But of course, if you're listening on Spotify or iTunes, that doesn't matter to you.
It doesn't matter in the slightest. Yeah, that's pretty exciting. No, I think it'll be cool, just alternating the uploads. Get some watch time for both of us, and man, it makes it easier to split the revenue.
Yeah, exactly.
That's the one thing I'm looking forward to, is that I don't have to manually work out how much money we have or haven't made.
Yeah, exactly right.
It's going to be so much more streamlined.
Absolutely.
But yeah, so alternating uploads, second one for 2019 now, so it should be a big year. And you've just powered ahead. You've gotten your whole January's worth of videos done. Holy smokes.
Yeah, I was really keen to just sort of get ahead on my content this year and sort of stay a couple weeks ahead, because I thought I'll do is, for all the content that's not, it doesn't matter too much if I'm talking about it a week later, or I've recorded it a week before. I'll get all of that content out of the way, and then if something pops up in the markets, I'll just have the spare time to sort of make that video really quickly and get it out so that it's sort of relevant, and also have time to do other things. And I just wanted to get on top of it a little bit more. And I think you're getting on top of your videos as well this year.
Yeah, I'm trying, man. So, some of these last videos that I've put out have been really big videos. Like, the last one took me so long to edit. There's usually I run between maybe 15 or 20 clips of B-roll footage or something like that, or just cards or something to put up on the screen. But this one was 60, I'm pretty sure. Wow. So it was rough, my last video, but I think it's a good video. I think it's all right. So, but yeah, I'm trying to get ahead as much as possible.
Yeah, awesome.
But yeah, always proves hard.
Yeah, it is. It's going to be very hard to stay ahead. I mean, I'm ahead now, but who knows where I'll be in a couple months. We'll see how we go. But anyway, in today's podcast, getting back to this, because this isn't our YouTube channels. We shouldn't be talking about that. But
YouTube talk.
Yeah. Just spend the whole podcast just promoting our YouTube channels.
Yeah.
No, but of course, we're going to start off with the indices and the news as usual. And in the middle section today, we're going to be talking about what brokerage sites to use. So we're going to be talking about what a brokerage site is, what is brokerage, how can you decide, and just sort of go through some of the major sort of banks that offer trading platforms, and just sort of talk about some of the different offers that are there. And then we've got a bunch of Q&As today, so that's probably going to be a big section of today's podcast. I think we've got 3 or 4 quite big questions to answer, so it should be a good podcast.
Yeah, well, let's get into it. I'll start us off if you want with the indices. So we've got, over in the US, we've got the Dow, which was, by the way, I should say this in the last 5 trading days. So the Dow was up by 2.2%, NASDAQ up by 3.1%, S&P 500 up by 2.4%. So a pretty decent week in the US markets. And then we've got the All Ordinaries over in now Australia. We've got the All Ordinaries up 2.7% and ASX 200 up 2.7% as well. So overall, US and Australia, they had a pretty good week.
Yeah. I mean, we had October, November, December, or maybe it was just November, December was quite negative. And now we're sort of just creeping up a little bit. It'll be interesting to see if there's any really massive... I mean, we've had a couple of big days, I guess. But
if you get that real big bounce back kind of thing.
Yeah, like a 8% week or something like that. Yeah. It'll be interesting to see something like that. I always just love the volatility in the market. It always makes it interesting.
Yeah, it makes you lick your lips. Yeah. You're like, oh yeah, boy, here we go.
Absolutely.
All right, should we get stuck into some news?
Yeah. So the first news story I had for today was, so Elon Musk and his company SpaceX, they launched their first rocket for 2019. So Elon Musk has another company other than Tesla, and that is SpaceX. It's a rocket company, and he's been launching rockets. When did this company start? It must have been a couple of years ago, I guess.
Well, no, it got popular. It's actually been going since, I think, 2008,
Wow.
I want to say.
Okay, yeah.
It's been going for a long time, but yeah, they've only, really gotten their technology right in maybe the last 4 or 5
Yeah,
years.
founded in 2002.
2002, that's right. Oh, that's right, because 2008 was the GFC, and that's where they almost collapsed. That's right.
Right, yeah. Yeah, but
Yeah,
it's been in the
yeah.
news and sort of getting more popular recently, which is sort
Yeah,
of what I'm talking about, I guess.
yeah. Ever since they've nailed that landing, the ability to land their boosters,
Yeah.
that's when they've become really popular.
Yeah, absolutely. So the rocket that they launched this year, the first rocket for 2019, was carrying satellites for the telecommunications company Iridium Communications. So
Yeah.
that's just a sort of telecommunications company. And apparently the satellites were deployed 1 hour after the launch, and then the Falcon 9 rocket was able to land back on the Pacific Ocean, which is what you just said. They have the ability to sort of launch a rocket into space and bring it back down, and that just still blows my mind that
It's pretty crazy, isn't it?
that's possible.
Yeah.
Because sort of space travel and all of that, like, it's very expensive, obviously, and especially when you've got a rocket and you're just sending it up and then it's just destroyed and it's useless.
Yep.
It makes it very, very expensive, and the fact that he's been able to sort of make these rockets reusable, like our plane, like we don't fly a plane to America and then just destroy it. Yeah, exactly.
Yeah.
I mean, the reason that
Yeah.
it's cheap is because we can fly it over there and then we can fly
Fly
it
it back,
back.
yeah.
And yeah,
Yeah, exactly right.
makes the sort of the landscape of sort of space travel and even just space business. Like, there's going to be a lot, especially with the increasing use of wireless and satellite devices. I mean, I'm sure there's tons of future businesses that don't exist right now that are going to need companies like SpaceX to launch their satellites cheaply into space.
I think it's actually, to be honest, I'm really interested as well in the idea of space business, because I think the stat is that by 2050 there's going to be an estimated 1 million people living on Mars.
Wow.
So that's pretty ridiculous. So I'm really interested in the business, or even like the legal stuff behind space. Like, who owns Mars? Like, does it form its own nation? Does it form, like, what is it, kind of thing? Because there's going to be people living there.
Yeah.
So it's going to be pretty crazy. And then once SpaceX gets this technology, once they get their Starship built and they can take us to Mars and back, then if you have a propellant plant on Mars, then you can go to the moons of other planets and that sort of thing. It's like, holy smokes, it just opens up the solar system. Like, this is some futuristic stuff, but it's going to happen in our lifetime. That's like far out.
Yeah, and as ridiculous as it sort of sounds to think that you could go from planet to planet, I just remind myself that there was a time when there wasn't even like boats, or when there was just boats, and the chance to travel to a country far away was just not really something you would ever think about in your normal life. And then sort of good ships came along, and we have planes obviously today that make it so quick, and now we don't even think about it. And it's like, in 100 years, it's likely that that's what it's going to be like for space travel.
Yeah, exactly. It's pretty crazy. And interestingly, for SpaceX, I put this in here, they actually just finished their test, or they're finishing up their test hopper for their new Starship, well, what they call the Starship, which is the Earth to Mars transport ship. And essentially what the hopper is it's a rough design of what it's going to end up being. And what they do is they just test the systems and fly it up a couple of kilometers and land it, fly it up a couple of kilometers and land it. So that's why they call it the hopper. But I thought that was interesting. You can look up pictures of it online. It's like this big stainless steel looking massive like ship. So it'll be interesting to see some of the tests of that as well.
It's a stainless steel bird.
Yeah,
Isn't that what people used to
much
say about planes when they were first around?
Yeah, probably. Yeah. But yeah, pretty crazy. SpaceX is one of my favorite companies. Well, I'm just like an Elon Musk fanboy. In fact, I'm sitting here wearing some Tesla merch right now. So Elon Musk is my boy.
we need an Elon Musk ticker that goes off every time you mention him.
a counter for the year.
Yeah.
How many times does Brandon talk about Elon?
We'll do a complication at the end.
Compilation,
yeah.
Yeah. Anyway, so that's that first news story. The second news story here is that Jeff Bezos is getting divorced. Oh,
Uh-oh.
Poor guy. Actually, I think that seems like it was coming for a while, but
yeah,
Yeah, world's richest man. I'm pretty sure he's world's richest man getting a divorce.
I think so, yeah.
Yeah, so Jeff and Mackenzie Bezos, they were married for 25 years. So that's pretty mind-boggling because that's like the whole way through Amazon.com.
Yeah, yeah. It was like Amazon was founded, I think it was like 6 months or a year after they got married.
Wow. So pretty crazy because that does leave about 130 billion US dollars to be divided up somehow.
Yeah. And I'm not sure if it's going to be an uncivil divorce because I read an article that said they're still going to be business partners. So I think that the marriage itself is just sort of not working. But in terms of the relationship between them, I'm not sure if it's too fractured. I mean, it would be really sad if it was so bad that Jeff just like loses like $65 billion. I mean,
yeah, it's pretty
it's
rough.
pretty crazy.
It would be rough. But yeah, so that'll be an interesting... Yeah, it does sound like what you're saying. It doesn't sound like it's too bad of a divorce between these two, but it will be definitely interesting to see how it plays out.
Yeah, absolutely. What else have we got?
And next story I've got is that Michael Cohen is going to publicly testify over Donald Trump's alleged ties to Russia. So this is something that I never really followed too closely. I've just been seeing it popping up in the media. So Michael Cohen, he got sentenced to 3 years in prison, and he's decided that he is going to come out and talk, hopefully honestly, about exactly what Donald Trump got him to do. So that will be a very interesting story to follow. I think I'll be following this story quite closely to see exactly what he says.
Yeah, I will be too. I mean, this Trump-Russia stuff's just been going on constantly for so long.
Yeah. Well, now we're getting Trump's attorney. Is that the right word for him? Trump's attorney to speak out. Yeah. So we shall see. We shall see.
Yeah, absolutely.
Yeah, so that's another one to watch. What else we got?
Yeah, so the last one I had here, just sort of something interesting that I was watching. So I've made a video on my channel before talking about Mike Wilson. So he's the top Morgan Stanley equity strategist at Morgan Stanley. And I made a video on one of his interviews at CNBC before because I find what he says quite interesting. Now, you definitely shouldn't take what people on CNBC or the guests that they have on CNBC, you shouldn't take what they're saying as truth, obviously. But I just personally like hearing what he said because over the past 12 months, I've been watching all of his interviews and he's just been right so many times. And he's been wrong very few times. So one of the things he said was that very early in the year, before those two massive corrections and before the October, December sort of thing, he predicted that there'd be a pullback in the cyclicals and value stocks. And that happened around sort of the mid-year, sort of March to June. And then after that happened, he predicted that that would roll on to tech. And tech stocks fell, I think it was like a month after that. I just find it interesting listening to what he says. Obviously, I don't use it in my investing sort of strategy or anything. I just like hearing what he says.
Yeah, of course.
And in the past couple of days, so he had another interview on CNBC and he made some predictions for 2019. So he predicts that we will see some more earnings downgrades. So at the moment, I think the forward earnings for the entire US market is expecting about 8% growth. He thinks that's going to come right down to 3-4% growth. So he thinks that a lot of companies are going to say earnings are not going to be as good as we initially thought they were going to be. So that's sort of the first thing he said.
So that could trigger some drop-offs in some of the more popular, maybe more overpriced stocks.
Yeah, and especially for a lot of investors who use forward PE ratios and they use forward numbers to do their analysis. I don't like doing that because at the end of the day, it's just an estimation. And when the sales actually do come in, sort of like we spoke about Apple last week, didn't we? And how there's got a slowdown in China. When the slowdown happens, they're not going to know it's going to happen. So they're going to be forecasting another big year, and then they're going to go, it's not going to happen.
Exactly. If you're having your biggest year ever, I mean, naturally, what do you think next year is going to be? You think it's going to be probably pretty damn good as well.
Yeah, exactly. Especially if your earnings have been trending up at 10% per year for the past 5 years. I mean, there's no reason
Yeah.
why you wouldn't project that into the
Yeah,
future.
exactly.
And there's got to be a time at which the consumer spending is going to slow down. And
Yeah.
so that's the first prediction he made. The second thing is that he still thinks that we're near the end of the cycle. So he thinks that there's still a big sort of downturn to come, a big sort of recession or something like that. But he thinks that the markets will have one or two more sort of bull runs before it crashes. So he thinks that
Right.
these stocks will downgrade. A lot of stocks will downgrade, and some of those stocks will get hurt, and then there'll be sort of a pullback. And he predicts that value stocks and cyclicals will be the first to move because they were the first to go down.
Yep.
And he specifically said that he's buying into semiconductors and home builders.
Right.
Yeah, so
There you go.
I mean, again, it's got nothing to do with my investing strategy. I'm not trading on
Yeah.
any of this, but it is interesting because he's been right in the past, and I'm
Yeah.
just curious to see if he's right again. I mean, he's talking about
yeah.
earnings predictions, so he has no idea. I mean, earnings could
There's no way of telling. yeah.
exactly. I mean, earnings could be great. Like, no one has any idea, but it is interesting to see sort of what he's saying.
Yeah, for sure. It's just like, yeah, of course, you don't actually act on any of this information. I mean, you'd be silly to act on just one person's opinion, but you've got to hear lots of opinions. Like you should take them all on board to form like what you think based on your own research. But it's good to like hear the different opinions just to see what other people think about the market and that sort of thing, of course.
Yeah, I mean, I just look at my individual stocks, whether they're overvalued or undervalued. I don't
Yeah.
really care about what the general market is doing. If one of my stocks is undervalued while the rest of the market's overvalued, that's fine. I'm going to buy it.
Yeah, exactly.
Yeah.
Yeah, pretty much. So is that all we've got to talk about for the news?
Yeah, so that's it for the news. I think we'll get you to start off with our section 2. So the main section of this
Yeah.
this podcast, and that is that we're going to be talking about brokerage sites.
Yeah. And I like this first sentence you've put in. Don't take this as financial advice.
Not financial advice. Yeah, we're not your financial advisor, and we can't even be your financial advisor over a podcast
No.
because we have to take into account your personal circumstances if we were going to do that. But we're not.
So we are... Sorry, you go.
Yeah, but we're not, and it's just our personal opinions just here.
Yeah, exactly. Yeah. We are simply relaying information here.
Exactly.
Information that can be readily found, that is readily available online.
Exactly.
But anyway, all right, well, let's get started. So essentially, we've got to start out, well, what even is brokerage? Well, it's actually kind of, as a new investor, I can understand how it doesn't really make much sense because these days it's like buying and selling shares is such an easy process. You just like log into your account, you click some buttons, and you either own shares or you've sold shares. But what the stockbroker does is the stockbroker is the company or the people behind making your button clicks actually happen. So when it comes to buying and selling shares, it's kind of easy to forget, I think, with how easy it is these days, that buying and selling shares is still a process of exchanging part ownership, exchanging ownership of bits of a company between a seller and a buyer. So it's actually like that's a full-on process. And of course, because the stockbroker takes care of this for us, we never actually see it happen. But that is what the stockbroker does. So the stockbroker takes what you order or what you would like to do. So you want to sell these shares or buy these shares, and it actually goes out and it makes that happen. And because they're the people that make that happen, they charge a fee for that. So that's where people talk about brokerage fees. So if you buy shares or if you sell shares, you're going to have to incur the brokerage fee. And the brokerage fee is not the same, dependent on what stockbroker you use, it can change. So that's where people always start talking about, what brokerage site should I use and that sort of thing. And then I guess the next thing that we try and think about is what stockbroker should we use? And really, that depends on a lot of different factors. So, you got to think about things like, are you going to invest in Australia? Do you want to invest internationally? how much, confidence in the security of the system do you want? How much customer service do you want? How much information, charts, research articles, how much of that do you want when it comes to your investing? Are you a day trader that needs all the charts? Are you a long-term investor that's unlikely to do anything for like months on end? So all of these kind of questions and the way that you go about your investing kind of play into what stockbroker you'll end up kind of going with. But really, when it comes to stockbrokers in Australia, there's really 4 safe as houses options. If you want to buy Australian shares, absolutely safe as houses options, and they are the 4 major banks. So if you didn't know, the 4 major banks, Commonwealth Bank, NAB, Westpac and ANZ, they all have share trading services. So oftentimes it's just easy for you to, if you wanted to start a brokerage account, okay, if you wanted to start buying and selling shares but you don't know who to start with, sometimes it is just easiest if you just start with if you're with one of those banks, just start with them. Because as we'll talk a little bit more about this, if you are going with one of the 4 major banks, if you do already bank with them, sometimes they give you discounts or deals when it comes to your share trading as well.
Yeah, I've found that to be true. I mean, I personally just trade with Combank through Combank and Comsec, and we'll talk about sort of what are the details with each of those in a little bit. But these 4 are just generally the easiest to get into. And I haven't researched too much into some smaller brokerages. But generally, I think that the services offered by the big banks are very good. And by services, I mean sort of the resources available to you, and the ease of using the platform on your computer or on your phone. I mean, we'll talk about customer service and that sort of thing in a little bit, I guess. But they're just the easiest. And I've just found that going into one of these 4 is just a good choice for beginners.
Yeah, they're certainly the most comprehensive. So for instance, I've made like an account on Comsec, and the amount of information, as you're saying, that's on there is unbelievable. Like if you want to see what the analysts are thinking, if you want to see what those guys are recommending or not recommending, if you want to have a look at how's the company growing, if you want to have a look at 10 years worth of financials data, then you can, all in the same place. So for someone that already has like a Commonwealth Bank account, then it's probably going to be easiest just to stick with them and go for a Comsec share trading account as well.
Yeah, exactly. And if you sort of bank with the same bank that you trade with, there's generally a better deal that you can get in terms of the brokerage per trade. So did you want to run us through what brokerage you'll be paying if you're investing with these 4 major banks?
Yeah. So we'll start with Comsec. Comsec is probably the biggest. Well, it is the biggest out there. So essentially, if you wanted to use Comsec and you're just an average Joe that doesn't bank with Combank, essentially you just pay $30 brokerage, and that's just it. However, if you do bank with Combank, and if you have what they call a CDIA account, which is a Commonwealth Bank Direct Investment account, then you only pay $10 brokerage for trades up to $1,000, $20 for trades from $1,000 up to $10,000, and then $30 from trades from $10,000 to $25,000. So you can see if you're just an everyday Joe, you're paying $30, whereas if you do have one of these CDIA accounts, then if you're making small trades, you're only going to pay $10 brokerage. So if you are with Combank already, then it might be worth your while just to stick with them, because you'll get that, if you're making small investments, you'll get that $10 brokerage. But then if you flip it over and have a look at like NAB, so for instance, NAB for Aussie shares, NAB offers $14.95 brokerage for trades up to $5,000, which I don't think is too bad at all. And then $20 for trades between $5,000 and $20,000. If we have a look at Westpac, then if you have a Westpac cash investment account, a DIY super working account, or an online investment loan and BT margin loan, the brokerage cost is only $20 or $30. The price is only $20 or $30 from any old bank account.
Right.
So that's Westpac. And then ANZ are interesting because they do it a little bit differently. They have a model where the first investment you make each month is the brokerage cost is a little more expensive, and then after that it gets cheaper. Yeah.
That's not good for our style of investing, because whenever I invest, I probably invest once in a single month. I would never invest multiple times in a single month. I don't think I've ever done that.
Or if I might invest like once every 6 months.
Yeah, exactly.
So, and then this comes back to like you pick the brokerage site dependent on, what you as an investor do. Like, obviously this might be good for someone who's a day trader who's making 50 trades a month or something. They know they're going to pay that expensive one first up, but after that it's going to be much cheaper.
Yeah.
So there's that to consider. So for ANZ anyway, they have that model where the first one's more expensive and then it gets cheaper. So pretty much trades up to $5,000, you'll pay $20 no matter what trade number it is. And then for trades that are between 5 and 10K, it's $25 for the first trade and then $20 thereafter. And then going up into the higher value trades, it's $30 for the first trade and then $20 thereafter as well.
Yeah. So in terms of if you're just getting started and you're investing amounts that are in the 1,000 to 5,000 range, so below 1,000, CommSec looks like it's the best in terms of brokerage.
If you bank with CommSec.
Yes, true. Sorry, I should have said that. If you bank with CommSec.
And then NAB's not too bad because you can get under $5,000. It's just a flat $14.95, so that's not too bad. And then Westpac is a bit expensive, really.
Yeah.
And then ANZ, if you're keeping, if they're not the best, but if you keeping your investment quite low, it's going to be $20 no matter what. So I think out of all of those, probably CommBank is the best if you bank with Commonwealth Bank. Apart from that, it's probably NAB for just the $14.95.
Yeah, and if you're going to go with one, if you're going to pick one of these four, and if you're with CommBank or NAB, it's probably best just to go with the one that you already bank with. That's probably just the easiest way to just do it. That's what I found. I was already banking with CommBank, and I really didn't want to move too many accounts over.
Yeah. Yeah, so it's pretty easy. You just stick with one of the four banks. But there are other options as well. So there's other brokerage options if you want to buy and sell Australian shares. So there's so many options, it's crazy. But I'll just talk through some that I've heard of and some that I think are okay. So I've used CMC stockbroking, which just offer $11 brokerage, and that seems fine. I've never had any issues as well. There's Self-Wealth, which a lot of people on my channel have been talking to me about, that they've actually really been enjoying. Now, I haven't used Self-Wealth before, but the consensus that I'm getting from all the comments I'm seeing is that they're quite good. So they pretty much offer $9.50 trades, and they also have a referral program. So if you can get someone else to sign up, you actually get like 5 free trades. So that's pretty interesting as well.
Yeah, very good.
And then the last one that I've heard of other people using is Bell Direct as well, which is just $15 brokerage under $10,000.
Yeah, and if you're investing very small amounts, it could be a nice idea to try and find a really, really low sort of fee brokerage. When you're starting to invest probably more than like $5,000 at a time, it doesn't matter too much between $11 brokerage and $15 brokerage, if that's what it is. But yeah, it is something to think about, because if you're, and it's also important. So for example, with CommSec, you want to make sure that you're investing sort of at the top of each of those brackets. So say for example, if you invest $1,000, you're going to pay $10 brokerage. So that's 1%. But if you invest $1,001, you're going to pay $20 brokerage, which is 2%. So exactly. You can think about it that way as well. You can sort of see which end of the bracket am I going to be in, and how can I minimize the amount that a brokerage fee sort of impacts the return that I make on a stock.
Yeah, exactly right. You do want to keep that in mind. And you're right. If you're investing with like a crap ton of money, then it doesn't really matter what brokerage site you use. In fact, in those instances, I probably would stick with the banks just for that that's like super
Added security.
mega security. Yeah,
Yeah.
added security. If you got a problem with your account, you can literally walk in to one of their shop fronts and say, I've got a problem. Whereas some of the reasons that some of these other ones are so much cheaper is because they don't really have shop fronts. So if you have a problem, you'll just be battling it out over the internet through emails to try and figure things out. So yeah, if you're investing with heaps of money, then to be honest, I would probably just stick with with one of the banks. But then again, if you are, starting out with a very small amount of money, then you want to obviously you want to try and get the best brokerage deal possible, because if you, like what you're saying, if you're investing only $1,000, then there's a big difference in brokerage between like $10 versus $30. It's like 1%, 3%. You've got to really pay attention, because then it becomes really quite hard for you to even recoup the brokerage cost, because remember, you've got to pay brokerage on the way in and the way out.
Yeah. Yeah, no, that's sort of just another argument against sort of trading in and out of stocks a lot. If you're not day trading and you're just sort of trying to sort of swing trade between stocks and trying to time the market, you're going to be spending a lot of money on brokerage fees, and it'll eat into your return faster than you think. 3%, I mean, of an average return, that's like almost a third. So if you did 3 trades, I mean, if you just matched the market that year, you've broken even. You haven't even made any money. So
yeah, exactly.
It is interesting. Did you want to run us through sort of international trading now? So we've spoken about sort of domestic trading, but some of these offer international trading if you want to invest in the US market. And that's a question I actually get quite a lot. How do you invest in the US stocks? Because I talk about US stocks quite a lot on my channel.
Yeah, me too. I used to talk a lot more about Australian stocks, and then I started analysing some American businesses, and I was like, whoa, all right, American stocks, here we go. Pretty much international share trading. So that's if you want to buy not just American stocks, but if you wanted to buy like stocks on the London Stock Exchange, or like in China, or wherever you wanted to buy stocks internationally. Most of the internet, the brokerage sites that offer international trading will offer lots and lots of different markets.
Yeah.
But essentially, I wanted to talk about 2 mainly. I mean, the only one that I've used, I've used 2 technically, but the first one that I used was just ComSec. Again, just go for the added security, especially when you're starting to put your money, converting it into US dollars and putting it overseas. Then I want to have something that's quite reputable, that so I can kind of trust that my money is exactly where it is, and I don't have to stress about it at all. So I feel like ComSec was quite reputable, and like they're the biggest brokerage site, so let's just stick with them. So they do $19.95 per trade. That's their brokerage, and that's in US dollars. 4 trades up to $5,000 US. So that's and then if you're going, you can go higher than that, and then trades up to $10,000 US, you'll pay $30 US. So that's one that I have used, and I've never had any problems with ComSec doing international trading. So, but that's obviously just me. I mean, it's one case study. But I think you've used these guys as well for international trading.
Yeah, that's my main international broker. The platform it's not great. I find it that it's a little bit slow at times to sort of just go through, and I've never used it to research information just because it's just irritating.
Me neither.
But I generally don't do too much research on brokerage platforms anyway. I do my own research, so that's not too much of an issue for me. But in terms of just being a reputable brokerage where like you said, your money is safe because it's the biggest bank in Australia. That's probably the main thing. Once you start dealing with quite large amounts of money, you can go and save $5 on brokerage on this weird website that you've never heard of, but do you really trust that they're going to be around? Like, they could go bankrupt or something, and
your money what's going to happen then?
You just get an email, sorry, we had to use your money to pay the...
And then, all of a sudden you're in this complicated email battle back and forth, and they're saying, oh, our customer service center is shutting down. You're like, wait, my money.
The number you have dialed is
Yeah.
disconnected.
Yeah. What? Yeah. So yeah, ComSec is pretty safe as houses for international trading. The other one that I believe we've both used and are using now is Stake, which is an interesting Aussie company that, full disclosure, we've worked with before and have been sponsored by in the past and may be sponsored by in the future. So keep that in the back of your brain. But we like this information is genuine.
Yeah, yeah.
So essentially, yeah, Stake is a platform that pretty much, it's an Australian company, so it's an Australian platform. It allows you to buy into US shares. And it's really interesting. It's an interesting way of doing it because instead of buying a finite number of shares, like I have to buy 10 shares in Facebook, instead I can just say I want to buy $20 worth of shares in Facebook, which is a very interesting way of kind of doing it. Because obviously some of these US stocks like Amazon or some of these other ones are you literally pay over $1,000 for one share. So that's a lot of money that you have to dish out just to even get one share. So this is an interesting way of doing it. You can kind of just say, oh, I want to own $20 worth of Amazon stock, and then you can do it that way. But the interesting thing as well is that it's brokerage free. So you won't pay any brokerage fees once you've transferred your Australian dollars into US dollars to then invest into the US market. You won't actually pay any brokerage. And that begs the question, well, if that's the case, then how does Stake make their money? And I think you were going to talk about that, weren't you?
Yeah, so I had this question a lot because I made a video and I did a promotion of them. And the question was, well, they must be stinging you somehow. Like, how are they making their money? They're ripping you off somehow.
Yeah, they're a business.
And I mean, I had this exact same question. I wouldn't just promote something without even checking that. So I checked it.
Yeah, me too.
And so they're brokerage free. How they make their money is simply through the exchange of US and Australian dollars. So when you transfer your Australian dollars into US dollars, there's a little bit of a gap between the exchange that they just take a little bit of profit. And you might think that that it could be worse than paying brokerage, but it's certainly not. I've compared it to ComSec. So with ComSec, you also have to pay when you exchange into US dollars if you're buying US stocks, and then you pay brokerage. And the exchange rate on ComSec and on Stake, it was pretty similar. So you're saving quite a lot if you were comparing the two directly. But yeah, it's very interesting because also in Australia, there's a minimum of, if you're trading through a traditional broker, there's a minimum of $500 per trade that you can make. Whereas that's not the case on Stake. You can invest, I think the minimum's 50, I think.
Yeah, to transfer. No. Well, you have to transfer $50 into your account to get started.
Yeah.
But then you can trade with however much you want.
Okay, yeah. So if you wanted to buy like a tiny piece of Amazon, because Amazon's $2,000 a share or something like that, then you can just buy $50 worth of Amazon or something if you just want to sort of test out the market and that sort of thing. I think it's quite interesting. It's an interesting concept. And it's kind of a bit of a... Oh, copy's a bad word, but it kind of Robinhood is the one that's sort of the big one in America that everyone knows of. That's a very similar concept to Stake.
Yeah. Of course.
And that's sort of where the idea came from, where you don't pay brokerage, and because of that, the company attracts a lot of investors in, and then that's how they make their money, through the exchange. And they don't need to charge big brokerage because they can just undercut the big banks who are trying to make $15, $20, $25 per trade.
Exactly right. Yeah, exactly. So yeah, Stake's an interesting one to look at. So that's kind of international trading, I guess. So I guess the last question is, what one do you pick? So as we were talking about, like what we were talking about before, is obviously it depends on what sort of a trader you are. Like if you're investing large sums of money, do you go for that security? That sort of stuff. If you've someone that's not got a lot of money, you want to get started, obviously you want to keep the amount of money that you're paying in brokerage, you want to keep that very, very low. So you also need to factor in, obviously, if you do have a problem, if you're like 70 years old and you hate the internet, and if you have a problem with your account because you can't read your numbers and entered it in properly and you just want to go to a shop front and enter and talk to someone about your problem, then you probably want one of the banks. Whereas if you're someone that doesn't really mind too much, you feel like you've got it all down pat and you don't mind if you're just resolving problems through emails or whatever, then maybe you go for one of the ones which doesn't have like a shop front, which obviously makes them cheaper businesses to run, which means they can offer you cheaper brokerage. So there's a lot of things to consider like that. So I'd just say, just consider the price, consider the deals, consider if you get a deal with your bank, that sort of thing. And just think about what sort of a trader you're going to be, or what sort of an investor you're going to be, how frequently you're going to be making your investments and that sort of thing, and try and just work it out from there.
Yeah.
But if worse comes to worse, you can always go back to the safest houses options if you're just too nervous about this, this brokerage company that is offering you the world, but you're just not sure about it. Sometimes it is best to just have the peace of mind and invest through one of the banks.
Yeah, and the only thing I would add to that is that it's not a hugely important decision. I mean, if you're really struggling to come to a decision, probably just go with one of the major banks, and it's not going to be like, you can change it later. I mean, it's not. It's not.
I've changed brokerage sites heaps.
Yeah, you're not stuck with it, so don't let it stop you from getting into the markets if that's something you're really keen to do, and sort of just get involved and sort of buy your first index fund or whatever and start to do that. Don't let it stop you there. Just pick one of the major ones if you're really having trouble, and you'll be fine.
Yeah, exactly. All right, so that's kind of our talk about brokerage sites. And that brings us to the last section of our podcast, which is Q&A. So, of course, if you're listening to this, make sure you leave any Q&A questions that you have down in the comment section below on the video, on the YouTube video, the YouTube version of the podcast. And as always, we just tally them up from week to week and run through some of our favorites. So I've actually only included a few because a lot of them were the same, which was interesting. So we're going to... just by answering a few questions, we're actually going to be answering a lot of people's questions today. So I'll ask the first one to you, Hamish. So the first one is, I recently invested in AFIC, which is an Australian listed investment company, and I plan to regularly invest in this fund twice a year. My question is, if you prefer an ETF such as VAS, which is an exchange-traded fund for the top 300 Australian companies, and long-term, would it be better to shift my money there, or is it worth investing in both AFI and VAS?
All right. So short answer, yes, I prefer index fund ETFs such as VAS. The long answer is, well, I can't tell you what specific product to do because we're not advisors. But my personal preference is just index funds, and I'll give you two reasons. The first is that they usually have lower fees. And by lower fees, I mean like 0.15% or 0.1% of your investment. I mean, a very, very tiny amount of the return that you make is going to go to those funds. Now, I had a quick look at AFI, and it seems like they do have quite low fees, but you can compare the two and sort of make up your mind there. The second reason is that if you invest in an index fund that just tracks the Australian market or the US market, you are guaranteed to make that market return. That's the whole purpose of an index fund, is to track the index and give you that return. Whereas when you're investing in sort of an actively managed funds, where there's a fund that has a manager that's trying to outperform the market, generally speaking, most of them can't do it over the long term. Now, you might look at, you might go on their website and it might say, oh, in the past 5 years, we've returned 17.4% or we've returned 13%, which has outperformed the market by this much. But generally speaking, if you're investing in these kind of funds, you're probably going to be investing for 20 or more years, I'm guessing at least. You're building a retirement fund.
Pretty much, yeah.
And over that time, I don't know if there's any actively managed funds that have done, I mean, there's obviously like Warren Buffett has done very well for his fund and things like that. I mean, that's not even really a fund, is it? But
no, it's just his business,
But generally speaking, there's not many that can do it, and the chance that you're going to pick the manager that's just a superstar manager and just outperforms the market for 20 or 30 years is very unlikely. They might match the market, which is great, but then again, if they have higher fees, you're going to underperform the market. So generally, I just like to stick with index funds. It's a lot simpler. You don't have to worry about the active manager making a bad decision and causing you to lose a couple of percent or anything like that. You just buy the index and If the Australian economy does well, you're going to do well.
Yeah, I'd agree. So pretty much this was a question that was asked a lot this week, actually. And I did a video recently just comparing listed investment companies and ETFs. So if you want to look at that, go check it out. But Hamish pretty much just said my entire video just then. But yeah, I pretty much came to the conclusion that ETFs are better because they're purely passive. So you don't have to pay asset managers to try and beat the market when the data shows that the asset managers can't beat the market. I mean, in Australia, we've got a good couple of big listed investment companies in Argo and Australian Foundation Investment Company, and their fees are pretty much the same as the VAS that was mentioned in the question, which is just an ETF for the top 300 Australian shares. So we're kind of lucky in that way, but at the same time, I mean, I'd rather just own the market and not own a stock where somebody that I don't know is guessing what stocks to put in the portfolio that I have bought into.
Yeah, and I'll just add, I quickly looked on their website, and I think it said over the past 10 years, their return was identical to the market. And I mean, that's great because they have the same fees as an index fund. So over the past 10 years, if you'd invested in
been the same.
AFI, it would have been the same. But the thing is, with an index fund, over the next 10 years, you're going to get the market return. With that listed invested company, that actively managed company, I have no idea if they're going to outperform the market. They might drastically underperform the market. And that uncertainty is just not what I want in that proportion of my portfolio. I'll leave that uncertainty up to my individual picks about whether or not they underperform or overperform. My passive proportion, I just want to match the market. I just want a safe foundation of my portfolio that is going to ensure that I at least get a proportion of my portfolio that matches the market.
Yeah. Agree.
So the second question we've got here is, I'll ask this to you, Brandon. Can you or have you covered what's better to invest in, Australian ETFs or US ETFs? What generally makes a better return? What's the risk? And he just says that they just say that they've been researching this stuff and would love to hear your opinion. So what do you think about that, Brandon?
Yeah, so essentially I just looked this up, and the average annualized total return for the S&P 500 index over the last 90 years is 9.8%. So that's the 500 biggest US companies. And then the average annual return for the Aussie market over the last 115 years has been 9.95%. So much of a muchness. But yeah, so it's pretty much going to be the same. Like, some people like America, some people like Australia. Like, it just is what it is. But the statistics say that there's much of a muchness. Now, it is worth pointing out that you don't have to invest in an ETF on the actual American market just to get exposure to American companies. So if you like American stocks and you want to invest in, say, the S&P 500, you can buy an Australian listed ETF that invests in the S&P 500. Okay, so for instance, in that example, the stock that you would be looking for is IVV, and that's a BlackRock ETF that is listed on the ASX. So all you have to do is buy an Australian company, an Australian stock, and that company is the ETF that buys into the S&P 500. So that's, if you don't actually have to invest on the US, in the US markets to get an ETF that tracks the S&P 500 or the American markets or something like that. Because obviously that just complicates things, because of course you've got exchange rates, you've got international share trading accounts and all of that. So if that's literally all you wanted to do, then you can, if you're in Australia, you can buy into the American market from the ASX.
Yeah, it's likely going to be cheaper for you to do that rather than to do the conversion and then pay. Usually the brokerage for international trading from Australia into the US is more expensive, at least for CommSec it is.
No, it usually is, yeah.
Yeah. So if you do want to just track the US market, you can do it from the ASX. That's my answer as well. I don't have too much more to add to that. The next question we've got here is, I was wondering if you'd heard of BrickX, a new way of investing in property. The site effectively turns the site effectively turns an investment property into a stock. It looks really interesting, but I was wondering what your opinions are. For the fees are quite high. but it could be a useful way to diversify.
Yeah, okay. So Brick X, a new way of investing in property. Well, it sounds like to be honest, it sounds like it's not a new way of investing in property. I'll be perfectly honest, because the idea of turning property into a stock isn't a new concept. So pretty much REITs or rights, however you want to pronounce it, they're real estate investment trusts, where essentially they're stocks where pretty much what you're doing is you can buy into an established property portfolio, but you can buy into that portfolio through buying shares, so listed on the ASX. So these rights or REITs are pretty much just companies that own income producing real estate. So the way I think of that is it's kind of like the hassle-free, low-cost way of owning a big property portfolio. Because pretty much you get the rewards of the income without, having to fix the toilets.
Yeah.
That's how I think of it. So I don't know what BrickX is. I haven't looked into it, but they might be pulling something on you when they're trying to claim that it's the new way of investing in property.
Yeah, I mean, I've heard of it before and I've seen their ads. And the fact that you say that they've got high fees does not surprise me at all. It just sort of seems like they're doing a REIT style thing on their own, and they're just trying to make it sort of unique and attractive to younger people, maybe. Personally, I'm just not a huge fan of REITs because generally in property, the return actually isn't that good. I mean, it's good. It's usually generally quite safe. But the return is probably around 7% per year over the long term, in that range. So probably a little bit less than the market. And that's okay if you're buying the whole house with a mortgage. And the reason is because if you use debt to buy the house, it amplifies the return. So you only put 20% down. Maybe you put $100,000 down on a $500,000 property. That $500,000 property is going to go up at 7% per year, but you've only put $100,000 in. So it's going to amplify the return on how much of your own money that you had to put in. And that just isn't the case with REITs because you're not using debt, and you certainly should not use debt when you're buying stocks of any sort, including REITs. But you're just going to make about a 7% return on your investment, which is not the same as making a 7% return on the entire property when you only put 20% in. And the other reason is that I just don't have much experience with real estate. I've learned about it at university, but I haven't invested in real estate myself, and I just stick to what I know, which is public businesses.
Yeah. No, that's fair. While we've been talking, I looked up what this BrickX is. So pretty much how it works, a brick, so it seems like you buy a brick, and then a brick represents a fraction of a property. So that's what that is. It says we handpick quality properties and divide them into 10,000 bricks. You can choose the bricks you want to buy or let us choose for you with Smart Invest. Okay. Invest and monitor your portfolio. Earn any net rental income in proportion to how many bricks you own. Earn any capital returns in line with the property price changes when you sell your bricks. So it looks like it's a kind of new way of looking at a REIT, because instead of just buying into the REIT and you buy into their total portfolio, it seems like through this site you can choose what properties you would like to buy into and buy into fractions of those properties.
Yeah, so it would be a little bit different. It seems like you're buying a piece of a single property, whereas when you buy a REIT, not only do you get a piece of the properties in their portfolio, you're actually buying, I learned this at university actually, you're actually buying a piece of the company that owns those that owns those properties. So you're not just getting the return from the property and the sort of the what do you call it, capital appreciation of the property. You're actually getting some return from the actual company that owns them. Whereas this might seem like a little bit different, but my opinion still stays the same, I think.
No, it does. It sounds like it's just a REIT but done a little bit differently. REIT, right? A REIT. Who knows? The A just stands for Australian too. If you see a REIT, it's just Australian Real Estate Investment Trust. The next question is, I have a question about your investing strategy. Do you dollar cost average your ETFs? I'll answer this first up. Yes and no. So I'm always periodically adding more to the passive side of my portfolio. But I probably shouldn't do this, but I change the amounts versus whether or not I feel the market is like really dangerous or not. Like I'm always contributing, but I might contribute a little bit less if I think the market's like really dangerous. So, for example, right now I think it is, so I'm not really putting too much in, kind of keeping myself in a high level of cash. But this reminded me of a quote out of The Intelligent Investor, which I've talked about in a video recently, but I'm going to read it out again because I think it's really quite interesting. This is what Ben Graham, the I don't know, what do you call him, the god of
the godfather of value investing.
Yeah, the godfather of value investing. He wrote The Intelligent Investor. So this is what he had to say about the 1964 stock market conditions, which he concluded, like what I conclude about today, that the stock market seems to be quite dangerous right now. So this is what he says. He says, investors who for some time have been following a bona fide dollar cost averaging plan can, in logic, elect either to continue their periodic purchases unchanged or to suspend them until they feel the market level is no longer dangerous. We should advise rather strongly against the initiation of a new dollar cost averaging plan at the 1964 levels, since many investors would not have the stamina to pursue such a scheme if the results soon after initiation should appear highly unfavorable.
That's really interesting, actually, because that's that last bit of that. Could you read that again? That bit about not having the stomach.
Yeah. So he pretty much says, we strongly suggest, we should advise rather strongly against the initiation of a new dollar cost averaging plan at the 1964 levels, since many investors would not have the stamina to pursue such a scheme if the results soon after initiation should appear highly unfavorable.
Yeah. So he's basically giving you two choices, and he's talking about the psychology of investment there. He's talking about the fact that if you just bought your first ETF right now, let's say if it was in 1964, and then the market just crashed 50%, you might not have the stomach to continue to dollar cost average into that crash. So that's what he's talking about, where he's like, oh, you should maybe wait if you don't think that you'd have the courage to sort of continue to dollar cost average. And that's the main problem with dollar cost averaging, I think, into an ETF, is that it's really hard to do it strictly. It's really hard to do it. So personally, I always try to sort of add more periodically at a specific amount, although it does vary. It's never the exact same amount that I do every single 6 months or whenever I regularly invest. It's always a little bit different. Generally, though, I sort of do what you do. So, for example, if the time that I set to invest in the ETF comes up in a month's time, but right now there's been quite a big crash. So say, for example, my time to invest was at the end of January. If back in December, because we had all of those massive corrections, I probably would have made the investment then. So I would have varied it a little bit, but not a huge amount. And yeah, it is interesting what Benjamin Graham says there. So you can dollar cost average if you're strict with it, but if you think that the market crashing 50% and you being down on a return quite a lot is going to affect you, then it might just be better to wait at the moment, because we are at the end of the economic cycle. So there is something coming. We don't quite know when it is. Maybe it's in a couple of years, maybe it's in 2 months, maybe it's already happening, but there is something coming.
Yeah, pretty much. I find that a lot of new investors too, when they first start out, they really get, like, we can say, yeah, I'm going to invest for the long term and all that sort of stuff, but when you do first start out, if you do see, like, you've made your first investment, you feel like, nah, I'll be sweet. I'm not going to be affected emotionally. But then you see all of a sudden your stock portfolio is going down sharply. I mean, for us now that we're not super experienced, but we've got a decent feel for the market. When our stocks go down, I don't know about you, but I'm just like, oh yeah, here we go.
Yeah.
It's like, time to buy. Oh yeah, give me some more red days, please. Whereas when I first started out, I was looking at my stocks and, it'd go down and I'd be like, oh, Jesus, like, oh, quick, get out, or just, I'm freaking out. And I find that my friends that I've gotten into investing as well have been a little bit like that. Especially when they first start out, they buy that first, ETF or whatever, and then it goes down heaps. And they're like, oh my God, like I'm down, like one of my mates said, I'm down like $50 right now.
I made a terrible mistake. I should have waited.
Yeah, exactly. I should have waited. I'm down $50. Like, well, and then I, of course, go through go through the whole, oh,
Spiel.
well, an ETF, you don't know what's going to happen in the short term. Like I said, you do know that in the long term, like the very long run, it will go up over time. So now that you're down $50, are you going to sell and limit your losses, or are you going to take this cheaper opportunity to buy some more because you know you're going to hold it for about 30 years? And then they go, oh, yeah, actually, it's not a big deal, is it?
Yeah, I think what helped me change that mindset was reading The Intelligent Investor and just reading a lot and listening to interviews from Warren Buffett, because it does make sense. You should be excited. If you really believe in a company over the long term, you should be excited to see it go down. If you're going to be
pumped.
If you're going to be a net buyer, so you're going to be buying more than selling, which if you're younger than like 30, that's probably true. Maybe even if you're a little bit older, that's probably true. You're probably still buying more than you're going to be selling. Then you want prices to go down. You don't want fuel prices to go up, because you're always going to be a buyer. You want them to go down.
Yeah.
So
exactly right.
you don't feel good when fuel prices go up and bad when fuel prices go down. It makes sense, because you want them to go down so that you can buy it at a cheaper price.
Yep. And the last question we'll go through here is, hey, quick question. What is the best platform to use to invest in a diverse portfolio if you wanted to invest in the S&P 500? Vanguard US seems to need a US address to be able to invest directly in the S&P 500, but the Australian site does not give you the option. Well, we've already answered this. Woo! So pretty much, any old platform, any old brokerage site you can use, depending on what you want. This kind of wraps up the whole podcast, really. Any old brokerage site, depending on what one you choose in the end, is where you can invest from. And if you wanted to invest in the US, in the S&P 500, then you can do it from Australia. You can. And that brings us back to the example of IVV, which is the BlackRock S&P 500 ETF listed on the ASX. So answered. Tick. Woo! Yeah.
Awesome.
We did it.
That's this week's podcast, I think. Thanks for listening, guys. And if you have any questions or any topic suggestions for that bulky middle section of our podcast, then make sure you leave them in the comment section of the YouTube video. So if you're listening on iTunes or Spotify, this YouTube video, the video version of the podcast, isn't going to be on the Aussie Wealth Creation YouTube channel. It's on my channel. So it's going to be, I'm taking over now, Brandon.
Yep.
Next week, you won't even be on the podcast. You'll just boot you off.
Yep. All the comments now that's on your channel will be like, oh, Hamish, this was great, but that other guy, I'm not so sure about him. Get rid of him.
Yeah, so you can leave a comment on my channel, hamishwhodder. You should be able to find it. I think I'm the only Hamish Hodder, which is good. I've heard some shocking stories about entrepreneurs who are sort of growing their presence, and they've got names that are the same as famous people, so they've had to change their names to get sort of pushed to the top.
It's funny as.
That's kind of sad.
Nah, you're definitely the only Hamish Hodder, because I have to put your channel card at the end of the podcast videos that I've been putting up. So I just Google search your name, and it's the first thing that comes up.
Yes. Anyway, we're just rambling. So thanks for listening, guys, and we hope to see you around here again next week. So see you later, guys.
All right, catch you guys.